You made 9 grand in March and 2,200 in April. Same job, same effort. The problem was never how much you earn. It's that the money shows up in waves and your rent doesn't. By the end of this video, you'll have a system that turns that jagged income into one flat, boring paycheck you pay yourself. Same amount every month, no matter what the business does. So what's the one account that makes the swing disappear? When income swings like that, 2 bad things happen. In a feast month, you feel rich, so you spend like it'll last. In a famine month, you panic, maybe put expenses on a card, maybe skip your quarterly taxes. Both moves cost you. Get this wrong and one slow quarter can leave you carrying a $3,800 credit card balance just to cover rent. And by the end, I'll show you the exact buffer that stops that from ever happening. Here's the fix, and it's a system, not a personality trait. We're going to take that jagged line and turn it into a flat, boring paycheck you pay yourself. Same amount every month, even though the business income never stops bouncing. Let's build it. Right now, most freelancers run one account. Money lands, money leaves, and the chaos hits your checking directly. We're going to insert one buffer in between. Every dollar the business earns lands in a holding account. Call it your buffer. Nothing gets spent from there. Once a month, on the same day, that account pays you one fixed amount, like a real employer would. The business has a wild month. Your personal account never sees it. In a fat month, the buffer fills up. In a thin month, the buffer drains a little to cover your salary. The buffer absorbs the swing so you don't have to. That's the entire mechanism. Everything else is just sizing it correctly. Here's where people go wrong. They average their income and pay themselves the average. But you can't spend an average. You live month to month, and the low months are when the buffer is thinnest. So we anchor to the floor, not the middle. Pull your last 12 months of deposits. Find your 3 lowest months. Say they average $3,400. That number, minus what you owe in tax, is roughly what a safe salary looks like. Here's what that looks like next to the average. Yes, the safe salary is lower. That's the point. It's a salary you can actually defend in a dry spell. The extra from your good months doesn't vanish. It piles up in the buffer, and we'll spend it deliberately later, not by accident. Buffer only works if you don't accidentally spend the tax money. So before anything reaches your salary, every deposit gets split into buckets the second it lands. This is the profit first idea, tuned for one person. Take a $6,000 month, and this is just a round example, not your actual numbers. First, set aside tax. For most full-time 1099 folks, 25 to 30% is a deliberately safe starting estimate that covers self-employment tax plus income tax. We'll use 30, so $1,800 goes to a tax bucket you never touch. Then a small slice for the business itself. Software, fees, say 10%, $600. A little profit set aside, 5%, $300. What's left, $3,300, is what's available to fund your salary. One honest caveat on that 30%, it's a safe starting point, not your exact bill. If you're a high earner or you live in a high state income tax state, you may need to set aside more, closer to 35%. And these are rough rules of thumb, not tax advice. Run your real numbers with a CPA before you trust any percentage. Notice the tax bucket isn't your money. It's the government's. You're just holding it. Freelancers who skip this are the ones blindsided by a 5-figure bill in April. Set it aside per deposit, and quarterly estimated taxes become a transfer you already funded, not a crisis. And here's why the bucket usually overcollects a little cushion, in a good way. Self-employment tax isn't charged on every dollar of profit. It's charged on 92.35% of your net profit. So on a clean example of, say, $40,000 in net profit, 40,000 times 0.9235 is 36,940, and 15.3% of that is about 5,650 in SE tax. Then you get to deduct half of that, about 2,825, above the line against your income tax. Net effect, your real tax bite usually lands a touch under the 30% you set aside, so the bucket leaves you a small buffer. Still not advice. Confirm the exact figures with a CPA. One question left. How full does the buffer need to be? The target is simple. 1 full month of salary sitting in the buffer before the month starts. Then you're always paying yourself with last month's money, and a slow month can't touch you. You don't get there overnight. Use a few feast months to build it. Here's a buffer growing from 0 to 1 month of salary over about half a year, funded only by the surplus from good months. And here's the whole point of the video in one chart. Same bouncing income on top, but the salary you actually pay yourself is the flat line underneath. The buffer ate every swing. One honest trade-off. This asks you to live on a steady number even in a great month. That discipline is the price. In exchange, April stops being scary. So, one buffer account between the business and your life. Split every deposit the moment it lands. Tax first, always. Set your salary off your lowest months, not the average. Pay yourself one fixed amount on the same day each month, and use your good months to bank 1 month ahead. Do that and the income still swings, but you stop feeling it. And remember, every percentage in this video is a rule of thumb, not advice. Confirm your real tax picture with a CPA. If this gave the feast or famine cycle a name and a fix, subscribe. The channel is all money math for people who work for themselves. Next up, exactly how much to set aside for quarterly taxes, including the $1,000 owed threshold that triggers estimated payments, and the safe harbor rule, 90% of this year's tax or 100% of last year's, 110% if your prior year AGI tops 150 grand, so the tax bucket is never a guess.